Good afternoon, everybody. Ladies and gentlemen, thank you for joining us here in today's exclusive webinar, Investing During Uncertain Times. I'm sure you guys are very excited about the topics. We've invited very good speakers today, and you will be well informed after this webinar, and you'll be able to find out what's out there, what are the opportunities, and how is it looking at for specifically for equities, not just offshore but also onshore, no? But before we begin, I basically want to remind everyone that if you have questions, there is a Q&A box on the right side of the panel. And if you have questions, even while the presentation is going, feel free to type in your questions. We will have a panel discussion later, and we will try our best to put in all the questions of the participants through the discussion so that we can be more informed about what's going on. No? As your trust partner, we know how it is important now more than ever for you to know what's going on and be constantly updated of the changes and different strategies that can help you optimize your earning potential. This webinar was created specifically for that purpose. So I won't prolong it anymore. Without further ado, I will be introducing our first speaker for the day. To talk about what are the opportunities in the global and local equity markets during this time of uncertainty, our first speaker for today is the Managing Director and Global Head of Equity Strategy for Jefferies, based in Hong Kong. He joined Jefferies in September of 2011 from Nomura, where he spent almost 10 years as the head of strategy. He is responsible for the equity allocation across 20 markets, as well as publishing top-down ideas, completing bespoke portfolio construction, and writing thematic reports. The strategy team provides regular updates on the factors affecting share prices, as well as contrarian ideas. He holds an engineering degree from the University of Exeter and a postgraduate diploma in Japanese from Stirling University. He is also a chartered engineer, and in 2015, he was ranked number 2 investment strategist by Asia Money. Ladies and gentlemen, please welcome Mr. Sean Darby. Sean, I'll give you the stage to you.
Thank you very much, and welcome to everybody who has taken the time to attend the presentation. My name is Sean Darby. I'm based in Hong Kong. I've lived in Asia for over 20 years, and I would like to thank Metrobank for inviting me to speak today, and also our co-branded partners, Regis, through which we distribute each other's research. Over the next 30 minutes, I'm going to take you through the world and highlight to you some of the big opportunities we feel equities represent globally, and also some of the factors that you should consider in investing over the next 12 months. It's been a very, very quick cycle for many people in terms of the strength of the recovery, and certainly over the next 12 months, we certainly will still see further dynamic changes to the investment landscape as central banks start to change their policy setting. So with that, perhaps the best place to start is to look at what actually happened over the past 15 months, because if you could possibly design a post-recession recovery, this has been the best that we've actually studied over the last 30 to 40 years. The central banks and governments very quickly realized the potential for a depression, and in that sense, they coordinated monetary and fiscal policy at a very, very rapid rate. So in fact, global equity markets actually bottomed out almost a year and 1 month ago at the very end of March. By then, the Federal Reserve had introduced quantitative easing programs again. It had directly lent into the United States economy, and a big fiscal package was also being coordinated, and other central banks joined in doing the same type of stimulus measures. But also we were very fortunate that the behavior of both consumers and corporates was also very different to the type of reaction that we saw during the global financial crisis of 2008. Instead of saving, companies and households went out and spent. And that in itself has been a huge sea change in terms of the style of the recovery. Whilst people worried potentially about a very soft recovery, we've actually really experienced a V-shaped recovery. And indeed, all the policy settings that were in place 1 year ago by the central banks are still in place today. And indeed, those same measures of fiscal stimulus are also being encouraged by most of the governments. So the style of this recovery was very, very different in terms of any of the other recessions that we've studied in the past. And in many ways, global equity investors have experienced one of the shortest ever credit cycles in modern history. The duration of credit distress in the financial system was extremely short. And there's been one other very, very big difference between this cycle and the previous 3 credit cycles that we analyzed. And that is that all the pressure, both on the corporate sector, was actually passed on to the central banks and ultimately the sovereign balance sheet. So in many ways, the stress in the system caused by the pandemic really never was as bad as it could have been, because governments took the other side of the balance sheet stress onto their own fiscal positions. And that really has been a hallmark for this recovery. So if I had to design a rapid recovery for the global economy because of a extraordinary event like the COVID-19 pandemic, this has been the best that you could possibly imagine. Well, many of the governments and central banks adopted a strategy of fighting a war. And that was very clear in the United States. Gentleman, famous economist, Mr. Paul Krugman, a Nobel Prize winner, got a large number of economists in the United States to publish a paper in which they advised the US government to fight a war against the pandemic. And any time that the US has fought a war, it really, really targets a very, very high level of GDP growth. And that is exactly what they have done in this cycle. So if we actually look, the policy settings globally have been forced to very, very low interest rates. Just about everywhere in the world are running the lowest level of interest rates. And equally, the governments encouraged a very, very large fiscal stimulus packages. So when we've looked through this year and next year, the very good news is that growth and profits are not going to be a problem for equity investors. Indeed, US GDP will be somewhere close to 7% this year. And again, that doesn't take into account the huge infrastructure stimulus bill that's being proposed and being discussed at the moment by Mr. Biden and the Democratic Party. So again, these economic numbers that we're showing here, there are actually upside risks for the next 12 months. So very clearly, the equity markets, which have seen some of the biggest stimulus measures, for example, in places like the United States and Japan, are experiencing some of the better earnings revisions. But in places like, for example, Europe, as we will discuss and show you later, their stimulus packages are actually only getting spent this year. And indeed, that means that we'll have a plateau of GDP growth for the next 18 months. That's again one of the best recovery scenarios that we could possibly imagine for global investors. So the speed of this recovery has also meant that people's perceptions of both inflation and interest rates have changed very quickly. It's been like watching a Star Trek movie where we've gone through this cycle at an accelerated pace. If I was speaking to you exactly 1 year ago, most people were worried about deflation or falling prices and falling economic activity. Their faith in the central banks being able to turn around the cycle, and also that there was not likely to be a big or meaningful pickup in growth, meant that everybody was extremely bearish, and also felt the chances or probability of inflation picking up was very low. Now, strangely, that's always what happens at that very, very depth of a recession. People are extremely bearishly dispositioned. And during those periods, as inflation expectations go from being very bearish or very deflationary, actually equities and all asset classes tend to do very well. And that cycle really played itself out up until September last year. From September to last year to where we are now, the markets began to focus more and more on the potential for inflation coming back into the global economy much, much quicker than expected. And if I was going to speak with you 1 year hence, I would expect to be highlighting that the probability of a rate hike in the United States is also growing. So during this period where the markets are debating how high inflation will go and when possibly interest rates are going to go up, only 3 asset classes generally do well. One of them is equities. The second one is inflation protection bonds, or what's called TIPS in the United States, and also commodity prices. Other asset classes like fixed income and credit tend to find themselves showing much, much lower returns during this period. So at least for the next 9 to 12 months, as the markets debate this trade-off between inflation and also higher interest rates, actually equities ought to be one of the best performing asset classes. And that's actually been reflected in fund flows. So once again, investors have reacted to the change of economic growth and economic health, and a change in inflation expectations by buying equities. And again, as I said, we would expect that performance to continue to run at least for the next year. Well, within equity markets, there's actually been also a debate about whether to buy very cheap or very low priced equities in relation to their book value or their earnings, or whether people should continue to own the very popular high growth companies such as the Facebooks, the Amazons, and so forth in the United States. Well, generally, when we're going from a period of very low inflation to much higher inflation expectations, value tends to do much better. The reasons for that is that people are chasing profit growth. And in that respect, the turnaround in earnings is helped by a much higher inflation rate. And in particular, the value shares tend to see a bigger turnaround in earnings growth. So once again, over the course of the next 9 to 12 months, we would still expect value equities to outperform their growth peers. Well, looking over the next 12 months, we are going to start to see the temperature changing. Central banks, one of them in North America, Canada, has already announced that it's going to start to halt the purchases of bonds by the central bank. And I don't think it's going to be unreasonable to think that the UK and also the Federal Reserve will start to do the same thing over the next 12 months. And certainly China has also allowed its interest rates to move up over the last 6 months to actually cool the economy down. So the first thing to say is that the temperature change or the temperature setting for interest rates is going to be at the margin more likely to be towards tightening. Now, there's a great deal of worries that the central banks may have overheated their economies, particularly in the United States, and that this might lead them to actually raising interest rates much faster than expected. Mr. Powell, who held a conference at Jackson Hole in the United States last year, talked about changing the target for inflation to one of an average inflation target. Now, he never actually told anybody what the average number was likely to be, except that it would exceed 2%. So far, the markets have been perhaps more worried that in the short term, the cost pressures will force the Federal Reserve to change their policy. We don't think that's necessarily the case. We think the Federal Reserve is much more careful in ensuring that there is full employment in the United States before necessarily changing the pace of government purchases and or actually changing interest rates. If we look at prices within the US, certainly the majority of prices have not changed materially over the last 3 to 6 months. And that's a good sign, because that would worry the Federal Reserve and probably force them into tightening much earlier on. But overall, the policy setting in the United States is likely to remain very loose over the next 9 to 12 months. In fact, in some of the areas of the United States, there has been quite a big and significant sea change in prices. For example, the prices of second-hand or used cars. But this is as a result of the inability of the major US auto manufacturers worldwide to be able to get hold of, for example, semiconductor chips or vital components. So much of the inflationary pressures are actually due to supply chain constraints and not necessarily to a huge or overwhelming demand side problem. In that respect, as I said, the central banks can probably hold fire in terms of raising interest rates over the next 9 to 12 months. The bigger problem for equity investors is actually margin pressure. So in the last 9 to 12 months, we've enjoyed at one period of time oil prices close to zero. We had very low commodity prices, wages were very low, transport and shipping costs were also very, very low. But all of those have changed very rapidly over the last 6 months. And in particular, transport costs or moving goods across the Pacific has actually increased 6-fold. So there's bound to be a lot more cost pressures coming into companies today than there was almost a year ago. In that respect, the biggest difficulty perhaps for equity investors is that the earnings are going to come under pressure, not because of falling sales, but actually from input costs rising much faster than the CEOs can actually manage. So perhaps the biggest difficulty for the S&P over the next 12 months is that very high margins, which tend to be a good sign or a good sign of health for corporate profit for the corporate sector, is going to start to decline. And that really will mean that over the next 24, 36 months, CEOs will have to be extremely aware of how to manage their cost pressures, particularly once the labor markets start to fully recover. The one last thing that perhaps might be out there as a risk for equity markets, and particularly in the United States and also in the United Kingdom, is that governments, having seen their deterioration in their fiscal positions, are going to start to raise taxes. The more popular way of restoring their budgets and their fiscal position is actually through raising corporate taxes, because companies have actually enjoyed near record turnaround in profits. Potentially, the new Biden administration may look to introduce some form of a wealth tax for the higher earners. But by and largely, the impact for equity investors may be through a very gradual rise in the corporate tax rate over the next 12 to 18 months. In this respect, the technology companies in the United States may be more at risk than other sectors because they tend to pay a very low effective tax rate in the US, mainly because they use the advantages of low overseas tax havens to actually lower their broader tax rate. The good news for the technology sector is that even during the worst period of the pandemic, there was never really a single month when the demand for semiconductors and IT equipment fell. So since 2018, every single month, IT orders go up, but companies still can't fulfill those orders, and the backlog of orders increases. That's a very bullish backdrop for the technology sector and represents this huge shift from analog devices all the way through now to the digital economy. The one thing, though, that we need to be aware of in the equity market is not just the tax issue for the technology companies, but valuations. If you have a higher bond yields in the US, which we expect the 10-year Treasury to go to 2%, then that means it's going to be much more challenging for technology companies that are not producing profits this year or next, and also those that have very poor cash flow. Hence, you've seen over the last 12 months that the very popular stocks in the United States have actually mostly traded sideways during the recovery. So if we look out over the next 6 to 9 months, one of the big success stories for some of the economies like the US, UK, parts of Europe, has actually been the vaccine rollout. Over the next month, during June, we do expect Mr. Biden to declare that the pandemic is over in the US. What really that means is that the US has obtained herd immunity, with over 50% of the population at least likely to have one vaccine shot. That takes all the pressure off the healthcare system. Now, this reopening that investors have been waiting for really does mean that we should see a very, very substantial pickup in demand for high-end consumer discretionary goods. What was interesting is that when we studied the last really bad pandemic back in 1918 in the United States, the very same thing happened. After you had the social and lockdown and restrictions removed, pent-up demand rebounded very sharply, and there was a huge shift towards high-end consumer discretionary spending, including restaurants and also, of course, going out and traveling. So we don't think things will necessarily be too different. And already, as we can see within the United States, the pickup in demand for airline tickets and also dining seats has turned around parabolically. It's interesting that Delta Airlines last month had to cancel 100 flights, not because of demand, but because they couldn't get staff back quickly enough to actually fly the planes. So the big turnaround potentially for the second half of the year is towards the service-based economies and those that have a very large proportion of earnings from tourism. This is particularly pertinent for Europe, where countries like Spain, Italy, Greece get a large proportion of their GDP from people going to visit those countries during the summer months. One last thing that we tend to want to keep an eye on potentially, which is much more difficult for the central banks and for society in general, is higher food prices. The dislocations in the supply chains and the very, very rapid demand for food has meant that the prices for grains, soybeans, pork, and even rice in China have risen much, much faster than anyone would have anticipated. This is a much more difficult policy measure for the central banks because they can't really raise rates, as it would not really influence or probably make the problem even worse. And in the space of the last 48 hours, China has clamped down on its own commodity markets to prevent hoarding or excessive speculation. Potentially, there's two other big upside surprises outside of what happens in services as we reopen. One is a further fall in the dollar, which tends to be very reflationary, particularly for emerging markets and also for global trade. So if the dollar were to weaken further from here, possibly because the Federal Reserve delays rate hikes, that would be very, very bullish for emerging markets. But companies now globally have huge amounts of cash on their balance sheet. And as we're seeing in the United States, they're buying back shares very rapidly at the highest rate in history, but also are starting to indicate the very, very exuberant expectations on capital investment. That would extend the cycle much further into 2022 and 2023. Well, just very quickly about countries out and regions outside of the United States, we're very excited by what's happening in Europe. The pandemic was almost the very thing that Europe needed to bind all the countries together and come out and start to issue common euro debt, and with a very, very large fiscal plan, which is something similar to the Marshall Plan that was introduced after the Second World War for all of the countries within the Eurozone. This is particularly good news because Europe's equity markets have lagged over the last 2 to 3 years. We think there's a real big turnaround story in Europe, possibly even better than in the United States. Within China, the change by the administration towards a much more domestically focused economy in really digitalizing the overall economy means that the country's not going to put further money into marginal export industries or smokestack industries. It really wants to do an electrification of the economy to get rid of those high polluting industries and decarbonize with a massive program on, for example, railways, but also it's going to let its exchange rate appreciate to allow it to import commodities at a much lower rate. One of the things that was missed at the end of last year, which we are very excited about, was the announcement towards the Regional Comprehensive Economic Partnership, which includes all of Asia aside from Taiwan and India. This frictionless trade and the size of the countries involved, which is similar to the European Customs Union, really would be important in driving the Asian economies within the whole penumbra of the Chinese currency system. Well, one country that would really like to have some inflation would be Japan. And there is a really good chance that Japan is going to see a sea change in its inflation expectations. It never really fell into deflation during the pandemic, which is very bullish, but also expectations now of inflation in Japan are the highest really since the 1990s during the bubble period. One of the drawbacks for North Asia, aside from China, is the low vaccination rates, and the potential downside risk is, of course, that we get a third or fourth wave of infections, and that's really potentially the risks for countries like Taiwan, very strong economies, but once again, the vaccination rates are potentially an Achilles heel for these economies over the next 12 months. So to sum up, this is one of those periods of time where you really do want to be owning equities compared to other asset classes. That period where people are debating whether there's too much inflation and when the central banks will tighten rates tends to be actually a good period for equities, commodities, and inflation protection bonds. It also means that value shares tend to have a window to outperform their growth peers. It's also potentially a period of time when international equities outside of the United States ought to do as well, if not better, than the S&P 500. And last but not least, the fact that these stimulus measures will still be rolled over into 2022 and 2023 really gives a high probability that the profit cycle and the high level of GDP growth extends much further than people would have imagined. Upside risks are from a weaker dollar, more buybacks and capital investment spending. Downside risks would be from very low vaccination rates in some countries and also potentially a faster rate cycle, tightening cycle by the Federal Reserve. Well, I'm going to leave it there. I'm sure there's lots and lots of questions. I wanted to thank everybody again for taking the time to attend the presentation. And I'm going to hand back to the host of this meeting and we can enjoy some fruitful discussion. Thank you very much.
Sean, thank you for that very fruitful, very insightful presentation. It's good stuff. Good stuff, man. We will be moving to our panel discussion to further sweeten things up for our audience. I will be calling in two more guests to join you, so Sean, please stay there. But before I introduce them, I would like to enjoin everybody for our audience to put in your questions in the Q&A panel in the WebEx platform, so that the panelists or maybe our investment teams at the background can also respond to your questions. All right. So now, to introduce our second guest, we have the Chief Strategist and Co-Head of Research at Regis Partners Inc. He began his career as a research analyst at BZW in Manila from 1993 to 1998. He then worked for WI Carr as an equity salesperson based in London from 1998 to 2002. He joined Regis Partners Inc. as a senior analyst in April 2002. He was then the industry specialist for Philippine banks and the property sector. While he continues to cover the Philippine banking sector, he is now principally responsible for the company's overall equity strategy. Ladies and gentlemen, please welcome Mr. Rafael Garchitorena. Rafa, can I see you, please?
Hey everyone.
Hi, Rafa. Now, for our third panelist is one of our very own, with over 28 years of experience in managing equity portfolios. He is currently the Chief Investment Officer of Metrobank Trust, overseeing the investment activities of the bank's over 500 billion of AUM of assets under management. Ladies and gents, I'm proud to bring in Mr. John Padilla. John?
Good afternoon, everyone. Thanks for joining. Thanks,
Hey,
Don, Sam, Rafa.
yeah.
Good to see you.
Yeah. Actually, this is a rock star panel, guys, if I may say. Let's begin with our first question. Let me direct it to Sean and John. Please give me your views on this question. In an investor's point of view, is there something unique about this current crisis compared to the other crisis situations in the past? Sean, maybe we can start with you, please.
That's a very good question. I think the two things that I would say surprised us and investors. One was just how far the central bank went in dealing directly with the issues in the credit. So the ability of central banks to offer guarantees on certain loans to ensure that the credit market remains orderly, that the central bank also promised to lend money directly if necessary, was way above everybody's expectations. And I would say, secondly, the very interesting thing really was that outside of some drops in prices, for example, like airline tickets, hotel rooms, some restaurant prices, overall, the price level was much, much more stable. And in fact, of all the equity markets that we cover, over the last 12 months, all of them have seen house prices go up. That was incredible. The big worry was that we would get a repeat of the GFC and house prices falling and have then a really, really bad banking crisis. Thankfully, we've had the opposite. So we've had a housing boom in the midst of one of the worst recessions. I would have given a 0% probability of that 1 year ago, and I would have been terribly wrong. Thank you.
Thanks, Sean. How about you, John? Want to chime in there?
Yeah, thanks for that, Sean. What's different about this crisis? I think it's the past crisis we've had. It's largely financial in nature, I would believe, hence the intervention of monetary authorities. But right now, I think you add a little bit of health issues up down there, social issues, hence it's a confidence building issue in my view. Therefore, we have a lot of work on our end to reinstate that confidence. You have to make sure that not only do the people who lost their jobs get their jobs back, but you have to tell everybody that it's okay to spend again. Sean was mentioning there could be that rebound in spending that could happen. We have to be prepared for that. But in general, I think you have to put into as a factor now health issues, social issues. Should I go out there and go to the movies again? And so it's something we have to see happening in the future.
Yeah, exciting times then. Uh, Now this one I have an investor behavior question. I think this is a better for Rafa. Rafa, how did the pandemic affect the way clients invest?
Oof. Interesting. I guess initially, obviously, the like any crisis, the initial reaction was just to sell everything, right? The difference, as Sean points out, with this crisis, is the central banks, even more so than the '08 crisis in the U.S. Not just the Fed, but virtually every single central bank in the world, including the central bank here, BSP, was more than willing and more than able to support the economy and liquidity with lots and lots and lots of liquidity. In the central bank here, it was not only buying aggressively the 5, 10, 15-year end of the curve, but also direct lending to central bank. And that gave the financial markets a lot of confidence that there wouldn't be a liquidity crisis. So yeah, I mean, I think how things have changed. I think the clear change, at least prior to maybe 3 or 4 months earlier, if Sean can correct me, was always a big shift towards the new economy as the pandemic meant mobility restrictions were tightened. As the world reopens, it's moving back into the old economy stuff. Hence, commodities are coming back up in the world. Frustratingly, here in the Philippines, you already have that big move in inflation, but we're not yet reopening. So that's hopefully a story for us in the next couple of quarters as the vaccines arrive. Fingers crossed, and as John says, right? I mean, a lot of it has to come back into confidence. That's dependent on things like government spending, the vaccine rollout, vaccine acceptance. I think there was a SWS survey came out that less than 1/3 of Filipinos are overtly willing to get the vaccine. There's 1/3 uncertain and 1/3 unwilling. So the faster we get people vaccinated, the faster we can get confidence back up, the faster we can reopen, and the faster the economy and the markets rebound.
All right. Thanks, Rafa, for that insight. I'll go back to Sean on the next one. It's kind of related to question of Rafa, but what mindset should an investor have, especially in these times of uncertainty?
I think it very much depends almost now on where people are based, really. I remember talking to my colleagues in January in the United States, and they were truly pessimistic. The pandemic was striking the US at its worst moment in time, and people could not appreciate or could not see a recovery unfolding. So in the space of 5 months, the US now has a vaccine, as I said, vaccinated 50% of the population. I was just looking a couple of hours ago, and Italy now has a vaccination rate of 50% as well. Now, Europe struggled to get the vaccines that it needed, but in a very, very short period of time, it's got the population almost to what we call herd immunity. So if I was in a position perhaps like the Philippines or countries where the vaccine rollout has perhaps been much more muted, I would still want to remain optimistic, because when we do see those numbers change, the service activity really responds very, very dramatically. And I think the data from the US and UK really gives people a lot of hope that the pandemic can be beaten. And again, the UK did not necessarily have a great rollout at the end of last year, but suddenly they were able to deploy the vaccine rapidly, and again, they're reopening. So I think the lesson at the moment is we should buy into the central banks and government measures, because they have worked in a lot of the countries that we are following. And it's not unthinkable that countries in Southeast Asia will have the same recovery, but perhaps on a more delayed basis. And I think that's going to be the story for Europe this year. It will be trying to get investors switching from countries that have done very well, like the US and UK, into markets where the bad news is just starting to ebb and you start to go through a period of better data. As they always say, it's when things go from very bad to just bad that you make your most amount of money. Being pessimistic here is not the thing to be doing. Thank you.
Thanks, Sean. Thank you for that. Now, let me direct a question to John. John, one of our audiences is asking, no, with the PSE's large or Philippine Stock Exchange's large rise in the past few days, stellar day today, by the way. Do you think we've seen the bottom already?
I said that I think 8 months ago. So probably I won't say it again. I won't say that again. But pretty much I think the 6,200 I think really tested everybody's resolve in this market. I really believe that being at 6,000 at a point when vaccination is rolling out already just didn't quite add up. And so with the optimism that vaccination will start to improve moving forward, I guess, with November, probably fighting chance that we will have herd immunity, at least in the NCR. Hence, I think pretty much I would say that the 6.2 would be the bottom already, and we start moving higher. Yeah, you're right. Just today, 300 points up. I was surprised by that big jump, but I was not surprised that the market is kind of turning around at this point.
All right. Thank you, John. Thank you. Now, the next question, we'll be directing this to both Rafa and Sean. Sean was mentioning a while ago about, the fear of going back to the GFC back in 2008. But one of the questions here states that what is your view on the banking sector compared to the prior crisis? So I guess Rafa, you can answer based on local, and Sean, you can chime in for a more global view on the banking or financial sector, that is. Okay, so go ahead, Rafa.
Sure. No, I think the banks, looking at the central bank's response, going back to the 90s, the Asian financial crisis, and the we've had many crises in between, right? Whether it was the GFC, the inflation crisis of 2011 and 2018, et cetera, et cetera. This time around, the banks were very healthy. The central bank made sure there was no liquidity crunch. In fact, the quote-unquote problem now of the banks is there's too much liquidity and not enough lending opportunities. Also, the banks, with maybe one or two exceptions, are extremely well capitalized. So even if the NPL numbers have been going up, that would be 4%, they're not anywhere close to the, within the perspective, just after the 1997 Asian financial crisis, our non-performing loans hit 33% of the book, right? Now we're at 4%. So that by itself is huge. The central bank intervention has been timely and swift and aggressive. And as Sean said, it's worked. The view now is the banks, so we've just had interviews with all the banks, including Fabian at Metrobank. I think there's just a lot of uncertainty, an unwillingness by the banks to take on risk. The Philippines is among the countries that did not have a loan guarantee program. So it's just waiting for the economy to restart for them to start lending again. And I think John's right. I mean, once we get things going, the investment cycle, first the confidence level has to go up, then the investment cycle returns. I think part of referencing back to what Sean showed earlier, many companies, many of the good companies are loaded up with cash. So I think there's the bizarre situation where you might see capex spend pick up in 4Q, 1Q 22, but the loan growth won't start 1 quarter after because the corporates are so heavily cashed up. So I think the prospects are good. The valuations of the banks are now quite low. So yeah, barring another bump up in non-performing loans, I think the banking sector is very, very well placed right now for a big rebound. They've underperformed. I think it's a matter of time before they bounce back quite aggressively.
Thanks, Rafa. Now, can we go a bit global on that portion, Sean? What are your thoughts about the financials?
So, very much similar to Rafa, the experience, I guess, that we've seen is that governments and central banks overestimated the impact of the pandemic on the economy. So in April, the Federal Reserve produced a report which showed that during a normal year, about 600,000 businesses in the US would normally close. And the pandemic only increased that number by about 200,000. Most of those were single person businesses. But what was interesting was that business formation in the US has skyrocketed during the pandemic. So best ever business formation in US modern history. The second is that because the companies were able to access loans and facilities from both commercial banks and from the central bank, the level of impairment charges has been much lower than anticipated. And I hate to say this, but the Australian banks are actually saying they may not have any impairment charges. English and Australians are always fighting about sport. So to hear the Australian banks talking about no impairment charges. So in many ways now, once the vaccine rollouts are successful in allowing the lockdowns to be removed, the bank analysts are now talking about write-backs, actually that the banks have over-provisioned and that they will be doing write-backs. And that's very much the case for the US. In fact, yesterday we wrote about the potential for the UK, and certainly there's a potential for other developed markets like Australia. So we would remain very favored towards the banks in the post-pandemic recovery.
Thanks, Sean. Now, for the next question, let's go for Rafa and John on this one. So, apart from the positive news on the vaccine rollout, what other signs are you watching out for to give you confidence that the Philippine Stock Exchange is showing signs of a strong recovery? So, Rafa and John, Rafa, you can start, then let's ask John to chime in after.
Thanks. No, for sure, vaccine is by far the number one. The far number two is inflation. I think that's going to be an ongoing concern for us. Imported inflation, as the whole world recovers, prices are going up, and that will handcuff the central bank a little bit in terms of its ability to further loosen and further support the markets. The one big positive, or 1.5, two potential very positive trends are, or reversal trends. One is we've seen, it's going to sound negative, but it's just positive. We've seen just non-stop foreign selling this year, like almost every day. I think our last count so far this year, we've seen about $1.4 billion leave the country, following last year's $2+ billion. So that sounds negative, but if you want to think about it, the market has held up remarkably well despite all that foreign selling. And it really all comes down to you guys, to the locals, Metrobank Trust, FAMI, and all these guys, and all your peers. No? I think the domestic financial market has remarkably deepened over the last, whatever, 20 something years that I've been doing this. The domestic institutional investing community is now half the daily turnover, and retail is now maybe another 15-20% of daily turnover. Now, on the one hand, it's still negative pressure from foreigners, but the second that turns, we almost don't need the foreigners to buy. We just need the foreigners to stop selling. And we could see a very, very sharp pop in the market. Yeah, so fundamentally is the vaccine and inflation. From a flow standpoint, it's really the tremendous growth in domestic participation in the market and a hopeful turnaround in the foreign sentiment.
Thanks, Rafa. Go, John.
I'll pick it up from inflation. So Rafa mentioned, I'd like to see earnings grow of companies. I'm not too demanding. I just want to see that there's semblance of recovery from the devastation that we saw last year, you know. But that to me would show that you know, demand is back, and that earnings are not just growing because of one-off or create fees or what have you, but there's really semblance of growth in demand, and again boils down to confidence of consumers. So I guess Rafa mentioned others. Foreign selling has to abate, but yep, that's it.
Thanks, John. Now, this one, I think I have one last question before we do a bit of closing remarks. I'll give this to Sean. Save the best for last. Given the efficient rollout of vaccines in the developed markets, are we seeing greener pastures ahead when it comes to developed markets? Could it get any better, maybe? I guess that's one way to rephrase it.
I guess the way I guess if we look at the sort of life cycle of the vaccine rollouts is, and to the point made by Rafa and John, is that foreign institutions buy into it. So the lesson really was that in China, once the Chinese got control of the pandemic, equity and fund flows were very strong. They've actually had a second run in China because they're actually now rolling out the vaccine very successfully. So the best way we can measure this is through currency markets. And China now has one of the strongest currencies through the pandemic. And you're seeing that now in places like Europe and also in the UK. So I think the issue is that 50% level of the first injection is really the target that equity investors or foreign investors want to see. That has been a very real clear signal that you've got the herd immunity in the system and you can relax all the restrictions almost immediately. So if we were to sort of sit here in maybe 3 months' time, I would be very optimistic towards ASEAN and, as I said, towards some of the parts of Europe which have very high levels of tourism, because that turnaround really could be extraordinarily strong, particularly on a total return basis as the currency strengthen as well. So I think the lessons from China, the US and UK is that you get almost a self-fulfilling momentum as the vaccine gets rolled out. Equity markets do well, sovereign bonds do well, and finally the currency returns really become very dramatic in underwriting the financial assets. So the lesson from developed markets: get the vaccine rolled out as quickly as possible.
Thanks, Sean. Now, before we wrap up, I hope you guys can give me a minute or two. Just wanted to present 1 or 2 slides here, but I'm gonna go back to the 3 of you and think of a final message for our viewers here. Okay, so to my team, could you show the next slide just quickly? So after that nice discussion, I would like to tell our clients what are your options Through the unit investment trust funds, you can actually make a subscription for as low as 10,000 pesos or $500 for US dollar funds. In your screen, you will be able to see 4 feeder funds that are in our product list. The World Equity Feeder Fund that's going global, US Equity Feeder Fund that tracks the S&P 500, the Eurozone Equity Feeder Fund that tracks the the MSCI Eurozone Index, and the Japan Equity Feeder Fund that tracks the MSCI Japan Index. And of course, going local, we do have those UITFs also. So you have the Metro Balanced Fund, Equity Fund, High Dividend Yield, and the Philippine Equity Index Tracker. So for those who doesn't have time to trade on their own, you would like to gain exposure, these would be a good start for you. Remember though, that these funds are suited for long-term investors with aggressive risk profiles. For more information on these funds, you may visit our website at www.metrobank.com.ph. There are several ways for you to subscribe to any of our funds. For first-time UITF clients, just visit any Metrobank branch. If you are an existing client with a dollar or with UITFs in general, you may now conveniently invest through Metrobank online, or you may simply contact your relationship managers to help you get started. Here in Metrobank, we are with you as you journey towards building your wealth through our UITFs. Now, I would like to go back to our 3 panelists, Sean, Rafa, and John. So, Mr. Sean Darby, Mr. John Padilla, Mr. Rafa Garchitorena, could you please, if you have some final words for our audience, maybe we could go for Rafa, John, then Sean, in that order. Before we end, could you wrap up, please?
Sure. I mean, thanks for the opportunity to speak. Obviously, I think it's very easy for us Pinoys to beat ourselves up and to focus on the negatives of the news flow, et cetera, et cetera. But I think with the vaccine rollout happening, slow, yes, but it seems to be picking up speed. I think it's really a question of when, not if, the economy will reopen. So okay, while the short term is looking a bit tricky, I think now's the time to start, looking at some reopening plays. Those who have appetite for longer term investments. There is light at the end of the tunnel at some point, hopefully sooner rather than later. And I'm looking forward to going out and seeing you guys in person again, not just over teleconferencing. I think the near term, there are near term challenges, but I think we're broadly looking more and more positive heading into next year.
Thanks, Rafa. Excited for that too. Okay, John, anything from your side, please?
Yep. Similar to what Rafa said, I think I would be opportunistic at this point. Last year, we were kind of hoping that it was a time to buy already, but of course, things didn't do well for us. But vaccinations rolling out, I believe that it will improve over the next few months and weeks. You have to be opportunistic, but at the same time, be realistic also. Make sure that your time frame for expectation of your returns is not similar to the previous down cycles and up cycles of the market you've seen. This is different. It may take some time, but I think this time is a very good level already to come in. But yep, be opportunistic, be realistic as well. Thank you. Thank you for joining, everyone.
Thank you, John. And last one, of course, last but not the least, Sean.
Well, I wanted to say thank you very much for inviting me to present. I'm really glad that people have a lot of interest in international equities. Perhaps the lesson or takeaway is from looking at some of the other countries that have been able to deal with the COVID-19, not only just through vaccination, but also suppression, like you've seen in China. We do think global equities do have a decent year of performance before perhaps the rate cycle kicks in. And as I said, equities should do quite well during a period of much higher inflation and also better profit growth. I wanted to say to everyone to stay safe and well. I look forward to also traveling to Manila and also to my co-host John and my also friend Rafael. So I do wish everyone a really good latter part of 2021. Thank you again for inviting me.
Thanks, Sean. We appreciate you being with us today, Sean, John, and Rafa, for sharing with us your incredible insights and ideas. I'm sure everyone has picked up something new from our discussion this afternoon. Of course, we would like to thank our attendees who joined in our session this afternoon. Thank you also to those who have submitted their questions. Before we end this session, we would appreciate if you could spend a minute or two and answer our short survey. We'll be flashing our QR code on the screen. Just scan the QR code to access the survey, and we'll also be posting the link to the survey in the chat box. Your feedback would be very helpful as we continue to improve our webinar series. Now, that concludes our program. On behalf of Metrobank Trust Banking Group, I would like to thank everyone for participating in this exclusive webinar. Again, I am Don Hernandez. Thank you, everyone, and stay safe.